So this is Mark Sobel. I'm the U.S. Chair of OMFIF. Today I'm delighted to be joined by a longtime friend and colleague, Joe Gagnon, Senior Fellow at the Peterson Institute for International Economics. Joe's one of America's foremost U.S. monetary policy experts. He served for a long time at the Fed in the monetary and the international divisions. And when both of us were much younger, he was at the Treasury in charge of oversight of advanced economies. That's too many years ago to count back. Joe, thank you for joining us today. So I always just ask an overview question to kind of give my guests a chance to set out basic views, and then we're going to dig in on inflation, labor markets, etc. So 50 basis points, everybody predicted that. But did you have any reactions to the decisions, the Powell's press conference, or the dot plot? Were there any surprises?
I don't know, surprise. I mean, it may have been a meeting where they actually took action, but it was so widely agreed what the action would be that there was absolutely no news in that. You're right. I think the dot plot went up by 50 basis points next year. Some people thought maybe it would have only gone up by 25 basis points, but it went up by 50 basis points. And moreover, there was a remarkable agreement on that we need to go above 5% interest rates, which was maybe a little surprising how 17 of the 19 people all seem to think they're going to have to raise above 5%. So that might have been a little bit of news.
So in essence, yesterday's decision, no surprise, probably. Well, let's dig in then into the data a little bit. Let's start just with the inflation outlook. So headline inflation is coming down. The October, the November data were viewed as favorable. But many of the prominent economists I've spoken with lately are focused on core prices, which, and after all, PCE core is the Fed's preferred gauge. And they've argued that when one sifts through all the core and trim measures and basket components, et cetera, that underlying inflation may be sticky in the 4 to 5% range and not so easily brought down. Some cite recent wage data as reaffirming this view. So, what's your sense? Is underlying inflation remaining on the high side? Or do you think we could gently, or perhaps even more quickly than many expect, come back to target? And according to what timeline?
Well, it's a bit paradoxical, but I think in the core versus headline is the key. I think that headline probably will drop sharply this year because food and energy prices are, if anything, falling now. So I think other people have noticed that too. And that's probably what workers and most people focus a bit more on. So that's good news for the Fed. As you say, they like core, not because they like it per se or that it's their target or anything, but that they think it has more information about the future, has more. Headline often fluctuates, but it tends to come back towards core. And so if they want a view of the future, they look at core. And I think that's right. So I think what's interesting here, though, is that core is perhaps not the best way to disentangle the data in this particular round because it's really goods versus services. And goods is almost all the energy and food is in the goods category. There's a bit in energy services, but there's mostly in the goods category. And so that helps on that score. But the other piece of it is non-energy goods like autos went way up, and they actually may be poised to come way down. We may see auto prices literally falling. We're already seeing used auto prices falling. We may see new auto prices falling. They were zero in the last report. So I think you have three things: energy prices, food prices, and other goods, all poised to fall this coming year. And that'll be good news for the Fed. But as you say, what's left is services. And it does look like services are not going to come close to target next year. And the reason is that service prices just follow wages. I mean, if you just, I just put a blog post out last week. And if you look at that blog post, you'll see that PCE services prices and the ECI measure of wage increases are almost identical. I mean, that's just amazing. I was amazed. I mean, they're almost exactly equal. Any deviations are quickly corrected. And the ECI wage increases are going at 5%, which means that PCE services will be going at 5%, are going at 5%. And that's just too high. They can be at 3%, and with goods prices, near zero or even falling, the average can be 2%, which is what the Fed's aiming for. But if PCE service prices are at 5%, there's no way they can hit their 2% target over time. And that's the thing what people are saying.
Okay. Just any views on the timeline for bringing prices down in that scenario?
Well, so the timeline for overall inflation is very favorable. I mean, it drops like a rock next year. I'm showing that by December of next year, overall PCE might be 2.9, and by December of 2024, it might be 2.4. So that's within spitting distance of their target. But the problem is that the PCE services underlying that forecast are only getting down to about 4% in 2024, and that's just still a bit too high. So I think the question is, can they get wages to come down faster without causing a recession or too much rise in unemployment? And that's the big question.
Okay. Well, let's look at labor markets for a second. Most economists see the labor markets as remaining rather robust now. And many of the people I've spoken with feel that unemployment needs to head substantially higher, even higher than in the dot plot, maybe towards even 5.5. If the Fed is going to take its 2% target seriously, and given the stickiness in services prices, as you say. So, but there are others who've argued that unemployment need not rise so much as quits rates come down. So I think Governor Waller has advocated this view. Larry Summers has been in the camp that unemployment's going to have to go higher. I think Bill Dudley is as well. Do you have a view on this?
Yes, I do. I'm in the more optimistic camp. I think two things. One is if we can get unemployment to the natural rate or the equilibrium rate of unemployment, which used to be 4%, is probably higher because of after effects of COVID, rose because of COVID for the first time in post-war history, and is coming down, but hasn't got all the way back to 4. And so I don't know where it is, but they have to get unemployment above 4. And the question is where, but I don't think it needs to be 6 or 7. It's probably between 4 and 5. So maybe 5, but hopefully less. So once you get to that, whatever that level is, the equilibrium rate, the rate that can be sustained indefinitely without inflation. Once you get there, inflation will come down quickly. Wage inflation will come down quickly. And that, I think, is where I differ with some people who think that no, they have this old mindset that no, actually, inflation stays wherever it is, and to get it down, you got to have excess unemployment. Well, the data just don't support that since the 90s. I mean, that was true in the 70s and 80s, but it's not true now because central banks, the Fed has much more credibility than it used to. And you can see that in surveys of long-run inflation expectations, which haven't budged. So that gives me quite a bit of confidence that if they could just get unemployment to the natural rate, the equilibrium rate, that will be good enough. It doesn't need to be punishing. But the question is, where is that a natural rate? We used to think it was 4. It could be 5 now, I don't know, or 4.5. that's the question.
So on the basis of inflation expectations, readings, and the like, you still think the Fed's got lots of credibility?
Oh yes, yes, yeah. It took years for the Fed to lose credibility back in the 60s and 70s. It took 5 to 10 years, really. It was an ongoing process. There's just no way the Fed is going to repeat that mistake, and they've been very clear about that and very resolute. And I think people get it. Somewhat to my surprise, I would have thought they would have maybe lost a little bit of credibility, but the survey measures really don't support that. The inflation expectations, especially the long run, which are the ones that matter, are a bit higher than they were in the mid 2010s, but they were too low then. So they're back to where they should be, which was back where they were in the 2000s.
Well, good. Well, now that we've gone through labor markets and prices and the outlook and your views, that kind of begs the question about how you see the current stance of monetary policy, the current Fed funds rate, and how long. So there are a lot of questions about the terminal rate. The dot plot, as you said, put the terminal rate above 5. Is that adequate in your view, given your take on prices and labor markets? And what about the question about, I think the dot plot didn't have rates coming down till 2024, so it's higher for longer, so to speak. Is that a vision you accept, or again, as some of the economists I've spoken with have argued, is the Fed funds rate going to have to go a bit above, if not more, sizably above 5.25?
Right. I think the Fed's projection, where it's heading, is a very likely outcome. I mean, and to think about who can, we always have to think probabilistically. We don't know the future with certainty. I think that's a reasonable path that could well happen. It may be the most likely scenario, in fact, I think, or close to. But I think the problem is that the risks are all on the high side, that they'd have to raise interest rates even higher, and that unemployment rate will have to go even higher. So the way I see it is, they're setting unemployment peak at 4.6%, and that may be right. I think it's reasonable, but it's more likely to be 5 than it is 4. So in other words, if you think that 4.6 is reasonable, probably that's where they can stabilize inflation at, fine. But if they're wrong, they're more likely to be wrong because they need to go higher. That they need to go to 5 or even 5.5. But I think that seems unlikely. But so 5 is my next most likely endpoint for unemployment, and that means that the risk is that they would have to tighten more to get a bigger slowdown. And there are the other thing is that there are these dynamics that we don't fully understand in business cycles. Some people think, I'm not sure how strongly I believe this, but many people think that once unemployment starts to rise a little bit, it's hard to stop it from rising a lot. That, you could definitely take that conclusion from previous recessions, but we don't have that many recessions, maybe a dozen to look at. And that's just not a big sample, and the conditions, you can point to very different conditions in every one of those other recessions. So I don't think that past performance at all guarantees the future outcomes in this case. But if you did look at past recessions, you would say, yes, the Fed has really never raised the unemployment rate by, 0.5 to 1 percentage point and not then gone further, So that's the worry. But just because it didn't happen, because I think the Fed didn't have a good framework and made mistakes, and there were other things going on. And I think in this case, it's different and there's grounds for hope. But you have to accept that that's the risk. And the risk is all that they'll overdo it, not that they'll underdo it.
Okay. Let me ask you a question about inflation target. I think most people think, with hindsight, that 2% is too low, that there are perils to being so close to the zero lower bound. And a lot of people think we should aim for a target of 3 or even 4%. But others who might agree with that also think that we're stuck with the 2% target, and that formally switching to a 3% target could undermine monetary policy credibility, open up a political can of worms. I've heard some even suggest that, well, the Fed should continue to say 2, but when prices come down and they're getting below 3, the Fed can take its foot off the brake, especially if there's a significant slowdown or recession underway. Do you have thoughts on inflation targeting?
I have, as you know, Mark, I've publicly been pushing for quite some time that we need a higher target. 4 is a stretch for me. I mean, I wouldn't say no if other people were happy with that, but I'm only pushing for 3. I think a rise from 2 to 3, first of all, wouldn't really be noticeable to almost anybody out there. But it would give the Fed more room for maneuver. Central bank would have more room to maneuver, and more than people think, in fact, because it actually gives you more room for QE too, it turns out, but that's a different topic. So yes, so the question is, is this the time to talk about this? And I think from the Fed's point of view, this is definitely not the time to talk about this, because they don't want to talk about anything that could change people's long-run inflation expectations, because that's key to their fight in inflation. So this is a bad time for them to raise this issue. They're not going to. They're going to resist even admitting it's an issue. However, if you watch carefully yesterday, Powell was asked about this by Fox Business. And he said, oh no, we're not considering that. Then he said, that could be a long-run project we consider, or something that could be a long-run project about that. But then he went right back to saying, no, we're not. And so, but the fact that he then said that there could be a long-run issue there really struck me. It's like, well, he didn't need to say that. He could have just said, no, it's not a consideration, blah, 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 that's it. But he said there could. So to me, it's clear that, it's occurred to them at least that this is something to think about. Now, I think the obvious context of that comment he made is that they've said they're going to do these regular 5-year reviews of their whole policy framework. And if the last one was in 2019, it was concluded in the very beginning of 2020, but it was mostly in 2019. So that means 2024 might be, the time that would be considered. And that's it's 2 years ahead, but that's something. So then the second part of your question is, well, when would they do this? Would they do that if they're succeeding in getting inflation down as soon as it hits 3? Would they then? Well, I don't know. That's kind of tricky, because if inflation's coming down and it gets to 3, probably there's in train further declines, and even if they ease up immediately, they're probably going to overshoot. So I don't know if you can do it quite so well, but I think that the thing would be if inflation comes down, suppose they pause next spring, inflation's still high, but it's coming down. And so it comes down, and then it sort of peters out when they get to 3. That's possible. Then the question becomes, in 2024, do we do a further raise in rates to complete the job and cause the recession that we avoided? And then that becomes clearly in play, because really at this point, if everyone's happy, and no one could tell the difference between inflation of 3 and inflation of 2, and they'd have to cause a recession to get to 2, and then it could come into play. Although from their point of view, if that was before they completed their policy review, that would be unfortunate. So I don't know how that will play out, and I don't know what the odds are. I mean, it's possible they'll get back to 2 anyway, before the policy review is completed. So I don't know. It's really interesting how that will work out. We really have to wait and see.
Did I just hear you say that your base case is that we avoid a recession?
No, so I think that sort of I split it up into three things. I think there's a 33%, whatever, 1/3 chance we'll avoid a recession. A 1/3 chance will technically trigger a recession, but it'll be very mild. And you could argue that their projection could be either of those two, because they do have a raise in the unemployment rate of about almost a percentage point. Although GDP growth doesn't turn negative in any one year, it's close to zero and could be negative for part of a year, which might be enough to cut. With that and the unemployment rise, might be enough to have the NBR call it a recession. I mean, as you know, a recession is a very subjective thing that's determined by a group of economists who meet, after the fact and then decide. So whether the slowdown triggers that or not, I don't know. I think it's a 1/3 chance it won't, a 2/3 chance it will. But within that 2/3 chance that it will, it includes very, very mild, probably the mildest recession in history. And then a 1/3 chance of a severe recession, or a normal to severe recession. So that's my thought. 1/3 no recession, 1/3 very mild recession, perhaps mildest in history, and 1/3 moderate to severe recession.
Well, I have two more questions for you. One, I'm going to ask because you mentioned it. You said QT, QE, and a different can of worms, but any thoughts on QT? I mean, can it run simply in the background? Is it going to contribute meaningfully to tightening of conditions?
I think it is. The tricky thing in all this, and it's gotten trickier over time since I first looked at it, as you remember, years ago, looking at the effects of QE, is that people have come to expect QE and QT. And so a lot of these effects happen in anticipation. It's the same. We see this all the time, of course, with bond yields. Bond yields are all about predicting what the Fed's going to do. So bond yields anticipate what the FOMC will do. And so any movement in the bond yields when the FOMC makes a decision is just the surprise component, the part that they didn't expect. And with QE and QT, it's even harder to tease out the surprise component. So it's really hard to see. But my sense is that people see this decline in the balance sheet and they sort of priced it in. And it's helping to push up bond yields a little bit. And I think people disagree on how big that is, but the Fed has estimates which I think are reasonable. I'm a little disappointed and puzzled that they don't talk about this at all in the same way they talk about the interest rate policy. And I think they should. I mean, I think it is contributing to the stance financial conditions, which is what they care about. They say that's what they care about. So it ought to be, they have measures. They could treat it more rigorously and talk about it more rigorously if they wanted to. They choose not to. I don't know, you may have some ideas about why they do that, but their preference is that they don't want to deal with this on a meeting by meeting basis. They want this just to be changed rarely, set on autopilot for a while, reconsidered once a year or something. That's their preference. Fine, that's okay. But the way they talk about it still seems odd to me. They don't really, many of them, I mean, there's some differences across the FOMC, but many of them seem to talk about it as if it wasn't part of monetary policy. It's kind of odd.
Well, I said I had two questions for you, but you just made me ask one other quick one. Since you mentioned financial conditions, do you think that, there's been a substantial easing in financial conditions over the past month, and do you think the Fed is going to be happier with the stance with financial conditions after yesterday's meeting?
No, I think they're probably not happy because what I've read, people say the markets are pricing in funds rate cuts next year, which the Fed does not agree with. So that means that the financial conditions are easier than they would like to see. So so I think they're probably not pleased with that, but I don't know, I think it's kind of a squishy thing. I mean, it's what they're trying to, their policy is trying to engender a certain level of financial conditions. If it persists or gets stronger, it might cause them to raise the funds rate even more than they think, right? I think that's how they think about it. So if financial markets persist in this belief that they're going to cut rates next year, they're going to have to raise rates higher. Fine, well, they'll do it.
Well, that was pithy and succinct. Okay, now I will ask you your last question, and softball for you. But because both of us have worked together in the international arena, we both know Fed policy has considerable global spillovers. Many foreigners say the Fed should take these far greater into account in formulating U.S. Monetary policy. But of course, the Fed has a dual mandate, and it's a domestic mandate. So how much attention should the Fed pay to global spillovers in taking its monetary policy decisions?
And the Fed people get asked this question. I've seen Ben Bernanke handle this question. And they always deftly avoid the real question, I think. And they always very deftly say, oh, of course, we follow international conditions, and we have a whole staff that forecasts the globe, and that includes some analysis of how our actions affect those countries, and we take that into account, and we have, so yes, that they do that. Now you could argue about how well they do that. I mean, I particularly remember the 2016 episode where people worrying about the Fed starting to tighten contributed to a global rise in the dollar and a slowdown of U.S. exports that actually measurably slowed the U.S. economy, that the Fed seemed surprised by. Remember, and they halted their hiking campaign in its infancy. And Lael Brainerd talked about this quite at length, and it really seemed to catch them by surprise. So, and it was an international spillover of what they had done. So, but of course, that was probably just they definitely thought about it. I just think they got the wrong answer and then they had to correct. So fine. They do think about it. I know, because I used to be involved in forecasting the trade balance. So, I was there. But that is not what at least some foreigners who ask this question have in mind, right? There are people out there that think, oh, the Fed should be worried about how its actions affect other countries for those countries' sake. And of course, the Fed doesn't care about those other countries for their own sake. And nor should it, in my view. For one thing, as it's easy for them to hide behind what you just said, their mandate is purely domestic mandate. You could argue it would be illegal, unconstitutional, whatever, if they were to deviate from that mandate, and I would agree. But I would go further and say, I don't think it would be good for the world if they did. I mean, I think, in fact, every country has its own monetary policy tools and fiscal policy tools, and it needs to use them. And if the impulse to blame someone else for your problems is very strong. I mean, every country does it. But every country has tools to use to guide its economy, and it has to take whatever the Fed does into consideration, just as the Fed takes what they do into consideration. But I think if they use those tools wisely and talk about them in the international fora that you and I used to go to, exist so that they can talk and get some insight into what they're likely to do and how they're likely to react to each other, that is a good thing. But this idea that the Fed should do something other than what is optimal for the US economy because of other countries' preferences is just a non-starter. And I don't think it would lead to better outcomes for the world anyway. I think I always like to point to Canada because I can't think of a country that is more overwhelmingly affected by US monetary policy than Canada. And yet they've had very good macro outcomes for decades. And, they don't complain about it. I mean, at least not, I don't recall being lectured by a Canadian about what the US is doing in macro policy, how it was hurting Canada. They just get on with it. They've had good outcomes, maybe even arguably better than our outcomes. So, just everyone should stick to their own knitting, as it were.
Absolutely. And as you say, there are fora for international cooperation where these issues are discussed, and the IMF is always ready to help. So thank you for that. So this has been a wonderful session, tremendously illuminating answers, great discourse. So I thank you profusely for joining us today, and I'll let you get on with your day job now. Thank you, Joe Gagnon.
Thank you, Mark.